Hello, my name's David Udall. I'm head of arable market specialists at AHDB. I'm here with our senior analyst from our policy team, Tom Forshaw, and we're going to be answering a few questions from the GMO Q&A session that we had last week, where we didn't have time to go over the questions. So thank you for taking time out to talk to us, Tom. You're the expert on WTO tariffs, and we had a few questions on those. So broadly, kind of putting them all together, the main context of the question is, well, what is a WTO tariff and how are they going to affect UK cereal markets going forwards?
Cool, thanks, David. So it's a good question, and there's a lot of media coverage around WTO rules-based trading, etc., and it can all get a bit confusing. So what are WTO tariffs? Well, WTO tariffs are a set of import duties that are applied evenly with all partners that are members of the WTO that a country doesn't have a formal trading agreement with. Now, WTO members can alter these tariff rates, which is usually a lowering of the rate, but it has to do so evenly for all WTO members. So, for instance, in the event of a no-deal exit from the EU, and the UK wanted to reduce its tariff rates for a particular product, it would have to do so for all countries, not just the specific EU country it currently imports that product from.
Okay.
Which in effect could add competition to the UK marketplace, but also be beneficial for sectors that are heavily reliant on imported goods, where, for instance, we have a net deficit.
Cool. I thought you were going to carry on then.
So, I was going to, yeah. Can we edit this recording?
Yeah, it can be edited, so we can just cut out. So we'll just carry. So should I then ask you?
I'll just
affect cereal markets.
Or just say, how does the UK external tariff affect UK cereal markets?
Okay. Cool. Okay, so how does the UK external tariff then affect the cereal market in the UK domestically?
Okay, so in the first iteration of the UK external tariff, which would be the tariff that we would apply to our countries that we don't have a trade deal with, cereal products were largely liberalised, which opened up our market to a number of competitive trading partners. However, in the most recent iteration, which is a bit known as the UK global tariff, the tariff lines have remained more aligned to the EU external tariff, which we are currently a part of, and which is relatively protectionist and offers protection to the domestic marketplace. There are, however, a number of exceptions to this, maize being the most notable one. So currently in the EU, we have a variable rate tariff on maize that's imported from outside the EU, and this varies depending on the price of maize that's imported into Rotterdam. So, for instance, if the price of maize was lower, that tariff rate would go up to offer protection to the domestic marketplace. In the UK global tariff, maize has been completely liberalised, which means that there is 0% tariff attached to it. And so depending on what price this maize is trading at on the global market could have an implication on the domestic marketplace for sort of substitutable components of feed rations into bioethanol plants, as well as like starch production plants, that sort of thing. So on the flip side, obviously there are products that we export from the UK into the EU, and although this is now concerning the common external tariff of the EU, there are products that we currently export to the EU that would be subject to tariffs that they aren't currently subject to, and that would offer a price pressure to those specific markets. There are also trade deals that we have access to as being a part of a member of the EU, and the UK government have been working on signing these rollover deals. And there have been a number of important countries that have been signed, particularly around the North African region, which can be an important market for malting barley, for instance. And these continuity trade deals are being continued to be worked on. I think one important thing to note, David, is that although the effects on trade will vary depending on whether the specific sector is in surplus or deficit, a lot of our research shows that sort of in any scenario, for the cereal sector at least, changes in domestic policy and specifically the reduction in those direct payments has a greater effect on farm income than any changes in trading patterns or the pressures on domestic prices that those changes may have.
Yeah, I suppose from my point of view, I think that's a real key aspect that we're thinking longer term with marketing, and at the moment the price of wheat for harvest 21 has been going up, even though we've been planting more wheat, which is the complete opposite of last year when the price was going up because we were planting less wheat. So the market's kind of a bit illogical at the moment, and you do get the feeling that that reduction in direct payments and support is the kind of the real key thing that farmers need to think about in the longer term. And I know there's all these kind of, like you're saying, the sort of tariff issues of now, but that sort of understanding of business and balancing risk longer term is going to be a key thing. I suppose we're talking about UK markets there, and the other key question that we had was around sort of, again, a post-Brexit world, and if having all of these sort of tariffs and all of these trading restrictions and policies put in place, do we need to think about just growing for a UK market on its own? Is that a sustainable thing that we can be doing?
I think it's unlikely, really. So going forward, obviously, we've got this policy of a global Britain, and UK is likely to broker trade deals with a number of parties around the world. And so I think in order to make the most of these trade deals, it's going to be necessary to cater to those specific markets. I think we need to understand as a country we're a relatively high cost producer, but of high quality products. So where it was maybe once boatloads of grain, etc., going forward it might be more about value added products. And so obviously it's going to depend on those particular sectors and whether we have the ability to export products on top of domestic demand. But we need to identify areas where the UK has popular products that can continue to develop demand overseas. One such instance would be malt to the likes of Japan and the US, and the provenance that our malting industries domestically have in those markets adds real value to those markets. I think furthermore, in a UK domestic context, we're a relatively wealthy population of some 66 million people. We've got a highly consolidated retail sector, which makes it valuable for domestic market and domestic producers. However, on the flip side, this is likely to result in increased competition from overseas partners that will be lining up to broker trade deals and get access to that valuable domestic market. So being able to compete profitably with those products on the UK marketplace or offer that point of difference is going to be important consideration going forward.
Yeah, I think this kind of comes back to the point you were making a minute ago as well about losing subsidies, because if we're going to be losing that big chunk of income, you can't really then be like this big net exporter of feed grain commodities, because all you're doing is just exacerbating that race to the bottom, and you're also then losing your income. So I think if you can focus on those value added things, that's going to be the key aspect, and whether that's domestic or being into processed products to export, that's the key thing. Tom Forshaw from our policy team, thank you so much. That was great to have you answer those questions for us.
You're welcome.
You'll be the expert we come to next time to find out what we need to know.
Brilliant. Thank you very much, David.
Hi, I'm Helen, and I'm here with Thomas to talk about a couple of the questions that came up at our recent Grain Market Outlook webinar, because we didn't have time to get through all the questions in the session. We're taking it in now to answer those questions that we didn't get round to, and today we're looking at those that affect the UK market. So one of those that came up was, do we have any figures on imports of milling wheat into the UK so far this season?
So the UK trade data isn't actually split out between feed and milling wheat, so we don't have exact figures. What we do know is that between July and August this year, we've imported almost 370,000 tonnes of wheat. This is compared with just 220,000 tonnes over the same period last year. We import wheat from a range of countries, but Canada and Germany are important suppliers of milling wheat into the UK. So the data for these countries can give us some idea of milling grade import levels. And looking at Canadian wheat, so our imports of Canadian wheat so far this season are at almost 100,000 tonnes, which is up 20% compared with July and August last year. And then looking at German imports, there are almost 70,000 tonnes, tonnes, which is up 2/3 compared with the 40,000 imported over the same period last year. It is, of course, important to note that all additional imports, regardless of quality, will add to the supply side of the domestic balance sheet.
So it'll be interesting to see how that plays out, but it does sound like we are having a greater rate of milling imports, which then sort of fits with the quality profile and the small crop profile that we were talking about at the Grain Market Outlook.
Exactly.
Okay, so go on to our next question then. Which was, will the fact that the UK has, so this is about maize import, tariffs on maize imports in the UK compared to the EU, and will the fact that the UK is setting a different path compared to the EU impact UK feed grain prices?
Okay, yeah, so the EU allows a set volume of imports per year with no tariff, and once that volume is reached, a variable duty applies based on the cost of importing maize. While the EU's maize tariff system does put a floor into the market, it only gives partial protection due to how it's applied. So it is calculated using a 10-day rolling average of the price, so it can take a while for this duty to kick in. If we look over the recent history, so the past sort of 5 or 6 years, a duty has only come into effect on a number of occasions, and there's also been a few times where the price has dropped below that key level and then risen back up again before the duty has had time to kick in. While the UK tariff will be permanently at zero, the EU's tariff has often been set at zero in the past few years anyway. So because of this, I don't believe that the UK's tariff being set at zero will have too much of an impact on the feed cereal prices for much of the time. In periods of very high maize supplies, we might feel some impact, but it just depends on how low the price of maize does fall.
Yeah, so it's that maize supply and demand relationship that's going to have an even bigger impact on our UK market then as we go forward.
Exactly.
And that brings us on to our final one then, final question. So as we've seen through much of this year, great supplies of maize and reductions in maize demand have been applying downward pressure on wheat prices. And so the question is, do we think we would see a feed wheat tariff? If we see a UK feed wheat tariff, the price of maize will have a greater pressure to UK wheat prices.
Okay, so we're talking about the tariff that we might face as of the 1st of January of £79 a tonne on the imports of low and medium quality wheat.
Yeah.
So this will come into effect unless we get a free trade deal, and then it also will depend on what the agreement is. So yes, a £79 a tonne feed wheat tariff is likely to see increased maize usage for both animal feed and industrial uses. If UK feed wheat is import parity, which will largely depend on the size of the crop, the size and quality of the domestic crop, and it will also depend on the price of what maize is available. So if the UK needs to import feed grains, domestic wheat prices could go up. If maize is priced expensively on the world market and feed wheat becomes too expensive to import because of the tariffs. However, there are, of course, other factors that we need to take into consideration. So maize needs to be cheaper for a sustained period of time in order to incentivize compounders to change the formulation of their ration. And it will also depend on to what extent how much wheat can actually be swapped out of the ration in favour of maize. So I'd say it all really depends on the price of maize. So global maize supply and demand is looking likely to have a greater impact on the UK pricing than it already does.
Yeah, so again, just coming back to that global supply and demand issue and how that shapes up. The other thing that might come in then is around the trade deals that are being negotiated at the moment, not just with the EU, but with other origins as well, particularly thinking of the one that was agreed last week with Ukraine. And and how that shapes up, because they're also a big exporter of grain, including wheat, onto world markets. So we need to see the text of that really to see how that all comes through, because there may be some gaps within that UK tariff. Thank you for everyone for watching. Those are our UK supply and demand estimate questions from Grain Market Outlook Conference, but you can watch the whole thing back on our website.
When can we expect to get a really accurate assessment of the Australian harvest, and at what level, either way, will it have a big effect on the world market? Well, I think with regards to the Australian harvest, we can be pretty confident that they're going to be coming out with a big crop. Current estimates are for a 91% rebound year on year. You know, they're moving into harvest season October through to December. The current 3-month meteorological outlook is for above average rainfall. So everything's looking pretty set actually to have this bumper crop. When will numbers start to firm up a little bit more? Will you get the weekly reports from Abaris, the Australian organisation, which are just going to put a little bit more certainty around them? And then there's the December crop report as well, which will just give the more of an assuredness around these numbers. But ultimately, unless anything pretty significant comes across the horizon, I think we can be pretty sure of a big crop. And what do you think? Has this already been factored into the market?
And also, Vicky, with the La Nina mention about the quality of the crop, if we don't know how much precipitation Australia are actually going to receive, and if this will affect the actual quality and where they can export to. So the actual markets, I personally think there isn't going to be too much of an effect on markets and pricing. We've known for near enough 12 months that Australia have had a resurge in wheat plantings. They've obviously suffered successive droughts for the last couple of years, and the market's known for a while that this large crop has been on the horizon. I know it's been gradually revised up, but I don't think there's going to be a significant amount of pressure come harvest time. When they start to harvest in December and when their crop comes online on the export sales in January and February. Is that all right?
Yep, that's good. Yep. Right. Let's move to the second question.
I can't really say anything about this, Vicky. Yes? No?
So, are some of the big importers likely to build stocks this year? Well, if we look at stocks to use ratio of some of the big wheat importers, and if we exclude the EU and we exclude China from those figures, we can actually see that the ratio has been decreasing just a little bit over the past 3 seasons. And already we've seen this year that North African countries and the Middle East, they're strong out the blocks with their purchases. So it looks like they're trying to get ahead of the game a little bit. Yeah. With coronavirus and the whole pandemic, there are reports of countries trying to make sure domestically they were self-served in case anything really significant comes on the horizon. But I suppose it's quite early to see at the moment as to whether this behaviour will continue, or whether actually if a second wave isn't borne out, we'll start to see some of this purchasing behaviour die back a little bit. Egypt at the moment, they're currently buying for end of November. Not seen that actually extend any further as yet, but that will be quite significant if we start to see those delivery schedules extend further into the future and give us a clearer idea of how much they're shoring up, or whether they're just front loading some purchases and this is normal buying behaviour. Okay.
Yeah.
Third and final question. With a return of Australia as a major wheat exporter, how much Russian wheat demand will be displaced from Asian markets into 2021, and where will the potentially displaced wheat demand come from?
Well, as we know, like I said previously, last couple of years, Australia have had a serious drought, which means their export campaign has been severely affected. So 2017-18 was the last time Australia actually had a serious export campaign. So usually Australia export to mainly China, South Korea, Philippines, Vietnam, and Indonesia. They're the top destinations they export to. And the actual, if you look at the trade data, the serious loss of their market is Indonesia and the Philippines. So one of the largest being the Indonesia, where a couple of years back, Australia were actually exporting through nearly 4 million tons of wheat to this country, and it's down a staggering nearly 80% in the past couple of years. But when you actually look at the data, a lot of this isn't a Russian wheat that is actually going into this country. So the Ukraine and Argentina have actually taken this export trade from Australia. So as we go into this marketing year, it will actually be interesting to see where the trade flows actually change from. As we know, Argentina have a lower wheat crop coming.
And we've seen USDA revise down Ukraine as well, haven't we?
Yeah. So their exports have been revised down as well. And also in the Philippines, the US and the Ukraine have taken Australia's exports that they used to do, obviously before severe drought. So I just think it's going to be there's not going to be a large amount of displacement, because I feel like there are other large producing nations that have actually been revised down while Australia has resurged.
And we're seeing a lot of Russian wheat going into North Africa and the Middle East at the moment as well. So, there's been strong buying behaviour from these countries for Russian wheat. That's just been helping support the price for Russian wheat over the past few weeks. And a lot of that shoring up a bit of the gap that's been left from EU production. Obviously, they've been down this year. We've had some real climatic and challenges and a real challenging growth in the EU this year. Russia's 82 million ton crop could just help shore some of that up. I think what we need to remember, though, is that the Russian export quota is still on the table. So we saw them enact this last year, although to levels we actually had like a minimal significance on the market. But what they haven't done is remove that from the table. So if they see their crop moving out too fast to these North African countries, then and if they're slightly unsure about any coronavirus effects, which is why they put the quota in the first instance at the earlier part of this calendar year, then they might actually just stem a bit of the flow of Russian wheat coming out. So there's a lot of unknowns that remain down the road for that.
Question 1. Do you believe that in this time of volatility, farmers should be analysing different break crops with fixed contract pricing to help combat this volatility?
Yeah, I think, it all kind of depends on where your end market is and how that fits in with your farm business. The answer is different for every farm business. Every farm business is different. So kind of look at the margins, and if the purchaser of this break crop is potentially, 100 or 200 miles away, will haulage affect your margins as compared to a previous break crop, such as oilseed rape, for example? Look at the individual breakdowns in each crop, but for sure there's premiums to be found in kind of niche break crops. The fixed contract helps as well to add a sense of stability in times of volatility at the moment, something you can kind of plan in, which is a rarity really at the moment, into your financial kind of statements for the year and plans. I think it's about finding something that works best for your farm. Does the break crop require additional machinery? If so, at what cost? As well, you kind of need to look forward as well. Is the break crop a one-time thing for this year because of the volatility ongoing, or is it a multi-year plan too? Those are kind of questions that need really answering before committing to anything, I think.
Yeah, I think it's a multifaceted thing. Certainly agree that you need to be very aware of your end market, whether you've got a buyer for that crop, because if you haven't, then your return on that is going to be £0 per tonne. Of course, someone will buy it, but it's just having that end market in mind. I think there's always scope to have a wide rotation and vary your exposure to different markets, but as you said, it's got to fit a wider plan, and it's a challenging one because the traditional rotation has been existent for a very long time, and it's going to be very complex for other things to come in there and to gain scale as markets, and therefore have the transparency. I think in small markets you can see just as much volatility as you can in the wheat market, for example, from year to year changes.
Yeah, definitely.
So question 2, with increasing uncertainty in global supply and demand, are we content with the UK's present level of self-sufficiency?
Yeah, so again, that's quite a big question there. I think we as a nation are at the moment a product of almost our own making. We've kind of been set up as a nation really to trade with the EU since 1973. So we've just kind of relied on that single market for both imports and also growing products and crops specifically for export markets into the EU as well. I think going forward, the level of self-sufficiency will start to increase over time, potentially, as the UK settles into a new norm with these new trade relationships. But it'll be a slow process, and it's kind of easily hampered, I mean, by seasons such as the current, where we lose nearly 6 million tonnes of wheat year on year from last season. So those things are quite difficult to plan for self-sufficiency reasons.
For me, it's a question of pure economics and comparative advantage. As the UK, we have got a very diverse agriculture sector, and we've not got an absolute advantage or comparative advantage really in the production of any crop. So we are set up, as is the rest of the world, to trade. We are a global world, and that the challenge that we are naturally going to face in the way that UK agriculture is set up is across the board, not just looking at cereals and oilseeds, but also looking at the picture for the dairy market and the livestock market as a whole. We need to be very aware of what those sectors are using. So there's obviously a large volume of soya used in those markets. There's a large volume of maize used. Even if we were to convert the entire UK area, we're still going to struggle to displace those crops in the volumes that they get used. So we do have to respect that other nations do have a comparative advantage over us to produce crops, and that is why the tariff system is as it is. Low tariffs on things we don't have a comparative advantage in, high tariffs on things we do, and that's naturally the way things are going. So while, as you said, Alex, self-sufficiency could well rise, I think there's always obviously going to be a place for global trade, and our self-sufficiency will be capped by the pure structure of globalism and of domestic agriculture.
Yeah, there's definitely a ceiling in place for kind of self-sufficiency. I mean, there's not any kind of first world countries that are, or any countries really, that are 100% self-sufficient in what they do. So trade is always going to occur, I think.
Yes, it's so much wider than just agriculture, isn't it? You look at anything like the services sector, the banking sector. There's so much of a capital flow that goes on there, which prevents 100% self-sufficiency.
Yeah.
So the last question: how do you think the introduction of the new land management scheme, or ELMS, will impact on future crop production areas?
I think the introduction of ELMS will definitely help the agricultural industry. It will highlight more the focus on conservation and the environment, and to the non-farming press particularly, who sometimes are quite negative towards the agricultural industry. I think as well, potentially we could start to see kind of the acreage that is perhaps not best suited to growing arable crops might start to withdraw out of rotation, simply, well, not simply, but to kind of get that ELMS payment assured on it, for that it might go to a more conservation purpose area. But I think it might impact on the intensive farming nature of the UK agricultural industry.
Yeah, I think it's important to define what we mean by intensive. Obviously, there's various, we're not talking necessarily the levels of intensivity that we'd see in, say, the US, but certainly UK agriculture has it's a machine, if you like. It's something that has quite a high degree of input for output. Whether we see that continue under ELMS, who knows? It's such a broad picture. But in terms of the pure area implication, I think that very much depends for me on how the new system pays, whether it pays enough to promote land going into conservation versus production, whether that's how it acts at all, is still very much to be seen. But certainly everything that's been spoken about so far does seem to have a bit of an environmental swing to it, and as such, I think certainly for the marginal land, that's where we could see a loss of some area to more environmental methods or more environmental schemes. But I think it's all going to come down to how it pays. If it pays better to keep producing in the way we're producing, then that's what will happen. If it pays better to put the land in environmental schemes, then you may well see more of that. I think there's still a lot of time before we see sort of the true impact of the scheme come through.
Yeah, I mean, it's a 3-tiered system, isn't it? So we could we await payment details on that and then kind of see how farms can fit into where they fit in that 3-tiered system as well.